Good afternoon. How's everybody doing? This is Craig Modelmog for the week ending April 16th. April 16th. Golly, it's Friday. Some days does your mouth ever just not work sometimes? Mine just doesn't work sometimes. I would like to still blame it on my COVID experience, but being I'm getting far beyond that time, I'm just going to say it's just Friday. And it's just not happened today, but it is April 16th. It is Friday. I do know that. And welcome to another episode of Wall Street X's and O's. For those of you who are joining us for the first time, this is uncut and unedited. My goal is to relay really good quality information that I feel that Wall Street is not talking about, and really educate you and trying to help you become a better investor. Help us all become better investors and stay focused on the data. I'm a big advocate for truth and data driving process, not allowing our emotions to overwhelm us in our decision-making processes. So anyway, without further ado, I'm going to kick this things off. This presentation is presented for informational purposes only. See, we're getting real specific on the disclosure here. None of the information contained herein constitutes an offer to sell or a solicitation to buy or sell any security or investment vehicle. It does not constitute an investment recommendation or legal tax accounting or investment advice. And investments can and will lose money. They are not FDIC insured, and this information is presented without regard for individual investment preferences or risk parameters. And I wish I could talk faster to get through this, but I can't, so I won't. Anyway, this content that I have is based on reasonable information that's believed to be true, which I will tell you I have done the research on it, and it is to the best of my knowledge true. So anyway, enough of that. Let's get on here. The top three things we're going to hit on this week's show is the number one, the federal deficit. Some interesting numbers here. We're going to talk about home sales, and can home sales keep ripping to the upside? As we know, they have just been on fire. And then I'm going to close it out with just some great stats for the week. I'm a stat guy. I love stats. But kick it off. Let's look at the federal deficit here. For starters, we are seeing the deficit growing. Obviously, we saw it with the former President Trump. Once the pandemic really got cranking, we've seen President Biden and his administration jump on board, kick off the biggest stimulus package on record. Now they're talking about an infrastructure package, which is going to hold a lot of interesting stuff. I call it a really interesting cocktail. But here's what's interesting. Just in the last year, so this goes since February of 2020, the U.S. federal deficit has increased by 83%. Okay, we've seen Europe increase by 52%, Japan by 22%. So you've seen a massive explosion in debt. Okay, our debt, when you look at the federal debt that's held by the public. So when our government issues new bonds, that's how they go out and raise money. They issue new government treasuries. Okay, they auction them off. They sell them to investors here in the United States. They sell them to governments all around the world and investors all around the world. That's how they basically raise money to operate on. That's what this debt or deficit is created with, okay? Right now, our level of debt that is held by individuals, institutions, investments, and governments is almost at an all-time high, going back to World War II, okay? Of which, that's not a good thing, though. In World War II, here's the difference. Let's compare and contrast. If you go back to World War II, coming out of World War II, we were a global manufacturer. Okay? Big difference from now. We are not a global manufacturer. We are a global purchaser. We live in a retail environment where we are spenders and we import everything that we purchase. You name it, most likely it is not made here in the United States. That's the difference. We could manufacture our way out of our debt in World War II, which we basically did. We can't do that now. Okay, if you look at projections on numbers from a global debt or from a debt standpoint, they're looking for our debt to exceed 200% by 2051. Now, that's just kind of linear line, which is a bunch of BS because that's not actual, it's not factual, but it just kind of gives us some parameters or guidelines on how out of hand this is getting. When you look at real interest rates, which you say, well, what do real interest rates have to do with it? Well, because we are in a very low real interest rate environment, that enables us to issue a ton of debt because it doesn't cost us anything to issue it. If you think if interest rates are so low, okay, compare and contrast now versus the late 70s and early 80s when interest rates were double digits, 12, 14%, okay, that was very expensive. Right now, I mean, today the 10-year Treasury closed at 1.57%. So if you want to look at a real interest rate, which you take the 10-year Treasury, you subtract it from the inflationary rate, which let's call it 2%, you are at a negative interest rate. Technically, we are at a negative real interest rate. So when you get concerned about our government printing so much money and creating so much debt, the only reason that we can do that is because it doesn't cost us anything to issue it. Now, should interest rates really spike and get out of hand, then we got a whole nother thing to worry about, and I don't really want to think about that because it's terrible, okay? Moving on, real estate. This is a big one. Real estate market is going bonkers, okay? I heard a stat yesterday, and it was from, I think, Red Hat. They are a mortgage or a real estate sales company, or it might have been, it could have been Realtor.com. Now it could have been Zillow. It's one of them. It's one of the major ones. See, this is where, that's why the disclaimer comes in handy, is when I can't remember where the fact is from. But they said on a average standard weekly basis, normally there's about 2 million homes for sale. Right now there's 500,000, ballparkish. Okay, we've seen we've seen inventories of single family homes at a 37-year low, and that's only because that's how far it goes back. Okay, it actually is much worse. They just aren't going back that far anymore. So I mean, these are kind of new data numbers. You look at another real interesting stat, and I had it ready, and then I hit my little thing and I jacked it all up. But I've got another good one. Here it is. How quickly are homes selling? Homes are being sold within 2 weeks 61.2% of the time. That's an interesting statistic if you ask me. If you look at existing home sales by price tier, as far as increase in sales, the greatest increase in sales, which is 81.1%, happens to be in the highest tier of cost of homes, your million plus homes. Sales have increased by 81.1%. If you go down the next notches, $750,000 to $1 million, those sales are up 66.3%. If you go 500,000 to 750,000, those home sales year over year are up 50.3%. So you're seeing the high end of the market moving like crazy. Lots of these are second and third homes, though. Okay, that's not me. But anyway, it's just kind of crazy, this home market. I know for here in Fort Collins, I have clients that want to downsize. The problem they run into is they can't sell their home and downsize into something cheaper. We're in a real interesting market in Colorado, very comparable to what happens in California and on the East Coast. Colorado is there, okay? If you look at what is going to sustain this housing market, people say, oh, it's about run its course. I disagree, okay? And here's why. Couple things. One, we've got some new things, stimulus talking, that Biden and his group are talking about. One, they're talking about anywhere from a $10,000 to a $50,000 student loan forgiveness program. That's massive. It kind of ticks me off having paid for my kids' school. I'm not sure how that helps me out, working hard and paying it off. But I digress, and that's for another story. And I actually need a martini to talk about that one because I'll probably get pissed off. But anyway, it's okay. It's okay. I'm not angry or bitter. When you add to that, they're also talking about a $15,000 first home buyer credit. Okay, so if you take those two things and you add that to the average age of a new home buyer in the United States right now is 32 to 33 years old. That's where that sweet spot is. And there's over 4 million of them. Okay, 4.8 million age 32 or 32 years old, and 33 is 4 million and change. Okay, a lot of people in that age group. All right, so if you kick in there this student loan forgiveness program along with a first-time home buyer program, what are you going to get? Well, you're going to get people positioned to buy homes that have never been able to afford a home, which that on one hand sounds fantastic. On the flip side of that, there are some people that just shouldn't own homes, okay? And my question is, are we creating another type of bubble when it comes to either home ownership or lending, okay? If you go back to Clinton administration forwards, the next couple administrations, there was such a push to create an opportunity for more people to own homes. That created our mortgage crisis. Because again, lots of people were buying homes that had no business buying homes. You know, it's not a bad thing if you can't afford to buy a home. Some people were just meant to rent. That's not a bad thing. So again, it's not pushing people into doing things financially that they're not capable of doing long term. That's where I have a problem with that. And that's where I think in the real world, I think sometimes there's this massive disconnect with our government. Okay, I just don't think it works. But anyway, it's going to be interesting. So I think on the near term here, we're going to see a home crisis continue to escalate. We have lack of supply. We have lots of people wanting to buy homes. And if they kick out these enhancements positioning people to buy homes, we're going to see things continue to go up at massive rates. So if you're a homeowner, sit back and smile. Okay, granted, it's only on paper, but it feels good to know my house is worth this when I only bought it for that. You know, I got some realtor dude that sends me a thing every month and I look at it and go, you know, if I could sell my house for that, whoever would buy it, I would tell them they were getting ripped off because I wouldn't pay that for my house. But that's just me. Okay. What could slow it down? Rising interest rates, okay? Because as we all know, as interest rates rise, also mortgage rates are impacted accordingly. Should mortgage rates increase here by 0.5% or greater, that could be what turns the faucet off or begins to slow it to a trickle. So watch interest rates and its impact on mortgage rates, because I think that is one thing that could slow it down. Do I think that's going to happen? I actually do. I think interest rates were kind of taken off. I think they're in this little pause right now. I look for them to continue to escalate because we're seeing it on the inflation side, which usually when you see inflation go, interest rates usually track it. So anyway, that's what I'm anticipating. To close it out here, some interesting facts. Used car prices year over year are up 26.2%. Headline producer price index, okay, increased by 1.4% to 4.2% year over year. That's the fastest pace of wholesale price inflation since September of 2011. That's a big deal. 47 million pets were adopted in the last year, okay? That's a good thing. I have two miniature long-haired cream wiener dogs, Fritz and Lola. You guys probably know them if you've seen them on pictures. I love them. So I'm glad we're adopting pets. That's cool. Energy stocks are up 27%. And oil has continued to rip as well. And I actually see oil prices at about $75 a barrel. That's interesting. And then I'm going to end this out today on retail sales. Retail sales were up 27% year over year yesterday. 9.8% from February to March. Remember, February was a down month, crappy weather. We got blasted with snow here, terrible weather throughout the whole United States. Sales were down. Sales are picking up. What have I been saying? People are going back to work. The pandemic is starting to lessen. The economy is continuing to open. Thus, what are we seeing? Sales increasing. I look for this to happen. We've got vaccines are continuing the strong rollout despite the J&J thing, although I think that's overrated. Personally, the COVID thing causes a lot of blood clotting naturally, which there was an Oxford Medical School University research that came out yesterday. So don't focus on the narrative of, oh my gosh, 6 people out of 7 million have really awful blood clots. Oxford found out that you are at more risk of contracting COVID, in which it causing blood clots, than getting a vaccine. So again, don't listen to the BS. I mean, narrative. My bad. Okay. Anyway, hey, it's been a good show. There are lots of good things happen. I look for growth to continue to accelerate in the economy along with inflation. I see that lasting through this quarter. The last half of the year is going to be interesting. So stay tuned. Keep your eye on the ball. Don't make emotional decisions. Let the data drive your process. For this week's episode of the Wall Street X's and O's, today is Friday, April 16th. This is Craig Modelmog, and I truly appreciate you guys joining me. I hope you find this stuff useful and helpful and fun, and have a fantastic weekend. And I am